You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing as simple as possible. And one of my favorite shows, it's actually a fan favorite. Our producers have told us that, we get a great reaction with these particular guests, and they are regulars at the Cash Flow Academy. I guess I should say they're dear friends of mine for many, many years. We have our lead instructor team here today. So we have Noah Davidson here. Hello, Noah.
Hello, Andy. How are you doing?
You're sounding good and doing okay. And we have Corey Halliday with us. How you doing, Corey?
Doing great. Excited to be here.
And one of the things that I always get constantly is people say, hey, what's your outlook for 2023 or for the new year? I get that a lot. And so we're going to talk a little bit about the State of the Union, where we're at. And we're going to talk a little bit about where we think things are going, put all of us on the spot with our prediction hat. That's our favorite thing to do, isn't it? Pull out the crystal ball that we don't have and guess.
Yeah. get graded by your work of predictions out in the future. And what's funny about predictions is if you look at like the Fed's predictions of things and how far off they are, it's pretty ridiculous. So I'm sure we'll talk about some of those ideas, but predictions are a tough business.
The bar is pretty low on Wall Street when it comes to prediction. And it's funny because no matter how bad people's predictions are, they always want another one at the new year. But we were correct on our predictions for 2022. And that means we got lucky. I don't think we're prognosticators, but we'll talk a little bit about that. But let's start a little bit with, maybe a year in review, or where we're at now is probably more important. So maybe we'll start with our technical analyst, Noah.
Yeah.
You guys are both technical analysts, but
well, what are we talking about? Like what we saw from last year, what we see?
Well, let's talk about what from a fundamental standpoint, where do you see things are now? Are you surprised where the market is now?
Oh, I'm not surprised at all. I'm curious more than anything, because this chart kind of, the way I read it is, well, it can go either way. And I think the market's kind of at a crossroads, and, where policies have us moving in one direction. The Feds keep talking about soft landings and trying to help us control inflation, and who knows how the market's going to ultimately respond to that. But it was a pretty volatile year last year. And, overall market's down quite a bit from the beginning of last year. And, this year I think is going to prove to be interesting as far as, predicting direction based off of technical analysts. I think that's probably not the right approach. Over the years, I've been wrong about my directional picks enough to understand that technical analysis has its limitations. I mean, you can certainly read the charts and get pretty good at anticipating moves, but longer term forecasts, I mean, I don't know what the market's going to do next week, let alone for the rest of the year.
It was pretty funny. I got some survey from one of I have several brokerage accounts, and one of them sent me a survey. Basically it looked like a way to gather information so someone could call me and either give me advice or try to get more money, or, it looked like one of those deals. I mean, I don't know that they really care about my market sentiment, but I was laughing because, they have first they talked about your experience level, and I'm checking all the boxes that are the highest, like as far as the number of trades I do and how many option contracts that I did, and they say, on the bottom it'd be like 1 to 10, and on the other end it'd be like hundreds or over 1,000 or whatever it was. So I'm checking this, and they say, hey, what do you think your level of experience is? And I checked it was like extensive or whatever the highest one was. And then it moved from that. And, I almost feel arrogant when I check the highest box on everything, because I've always felt like a student anyway. I've never really felt like a guru or anything, but, I answered them honestly. And then they started asking me my sentiment And they went through everything, man. They went through every sector and was I bullish, bearish, or neutral? And the final category was I don't know. And I checked, I don't know, 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 over and over and over again. Then they'd go through policies and I'd check what I thought it was, and then I'd come back to bullish or bearish, and they'd say, where do you think technology is going to go in the next 3 months? I says, I don't know. And it was just kind of strange because you'd think that if you are a teacher of investing, and you'd think that if you have an academy called the Cash Flow Academy, that you know all that stuff. At least I think a layperson would think it. But I think that's really but then I realized if Warren Buffett were filling this out, he'd say, I don't know either.
He talks about that a lot, in that it's very hard to predict. Well, I like the saying, it's easier to know what is going to happen than when it's going to happen.
Yeah.
And I think that's kind of what you're getting at, is it's easy to kind of see the progression of things. It's very hard to get the timing of all these things precise. We can see that the Fed is moving from a QE to a QT, which means quantitative easing is easy money policies, low interest rates, all these sorts of things. And now they're transitioning into raising rates and making money less readily available and so on. So we can see what's happening. That's the what is happening, right? But the when and trying to predict all the little bumps and this and that's kind of it's unrealistic to expect yourself to get all of that precise.
Yeah, I mean the technical trader, every technical trader I know, and we'll get into this, is all about their exit and their stop. It's about their ability to adjust and hedge. It's not about being right. It's about dealing with being wrong. It's not about picking a ship that is not named the Titanic. It is about picking any ship that has a lifeboat on it so you don't die. And if the ship does what you think it's going to do and you don't have to get out, great. So it's much more about insurance. It's much more about your quality of plan B than guessing on your plan A right. And so that's a real lesson, I think, that takes a while for people to understand. And then on the other side of this, if you're a cash flow investor, which is the biggest emphasis we have, predicting what will happen to a dividends are more resilient, or I'll say less volatile than stock prices. Certainly during COVID, some guys pulled the dividend off the table. They had to. Others, they just kept it on going. It was very resilient. And if you look at if you were to chart, dividend distributions from many, many companies, you'd see a lot more upward trajectories without interruption. One of my favorite dividend stocks I have is ExxonMobil. And while I might say their price might go all over the place because it's tied to fuel, for 36 years, 40 years, whatever it is, they either had their dividend remain the same or go up. They've never had it pull back one time. And it's hard to find a stock price that's done that hasn't had one pullback in 36 years. And then the other part of this is while options, if the stock price falls, certainly the options on it will be less expensive, but the options are much more consistent because we're really looking at different, a whole different. If people could catch this, you're really approaching the market in a whole different way. You're in terms of dividends, you're approaching it like Warren Buffett by saying, look, I'm a business owner, and yeah, I might sell less Fruit of Loom underwear, or less Duracell batteries, or less Dairy Queen blizzards. I might sell less of them, but I still think there'll be a market for it, and I still think we'll be able to have some profit out of it. It might not be a banner year, but it's pretty tough to put us out of business because we're a big, strong company. And then on the option side, as long as the options market's around, you can always write a covered call, or if you see an opportunity, you can write a cash secured put and bring in some income. So it's a different game to play the cash flow game than the up and down price game. So those are my thoughts. Corey, what do you think about, you say you think we're going to see more tightening. I do too. Why do you think? I was looking at the Fed, what is it? Fed Watch, Noah, that we always look at. I was looking at it last night.
Yeah.
And, it's as lopsided as I've ever seen it on a quarter point instead of a 50-point move.
Yeah.
What are your thoughts, Corey, on the Fed? Because that's the biggest
Yeah.
thing I think that drives this stuff.
Yeah, and so they're getting towards the end of their tightening cycle, right? We had historic moves. They went and talking about last year's predictions. I remember last year we did a class on inflation, and this inflation class, well, this was probably maybe it was a year and a half ago, but we talked about how there was likely to be this wave of inflation. It was before the inflation numbers had just gone through the roof. And the Fed basically, as inflation did start to spike, and it didn't take massive amounts of education to realize, hey, we've just printed trillions and trillions of dollars. It's going to have some inflationary effect. Well, when that started to happen, the Fed called it transitory. And their projections going into last year, into 2022, were for zero interest rate hikes. Well, they not only hiked rates, they hiked rates more often and by a bigger margin than ever before in history. We went from 0.25% on the Fed funds rate to 4.5%. We've never had that historic of a move. And it was just, I mean, it kind of rocked the markets, and it was them battling inflation and so on. And now we've started to see that, okay, they're probably towards the end of their rate hiking cycle where they're going to kind of slow that down a little bit. And inflation started to come down, where we started to see inflation backing up to now it's back to 6.5, which is way too high still, but kind of trending in the right direction. The problem you're going to get into, though, in my opinion, is that I think inflation, although it's going to kind of trend a little bit lower, I don't think it's going right back to 2% like they want. I think we're going to stay sticky high in the 4-ish% range. Now, the part of that is due to the effects of like rent and some of those things that don't tend to back up as much. Other parts of it, the reason that inflation kind of has a tendency to stay sticky, and a lot of, the Fed is nervous about this, is basically it's hard to put the genie back in the bottle. Kind of, you've started to see it happen. And so now it has knock-on effects where a lot of corporations are now in the raising price cycle, right? And they're raising prices to stay ahead of their costs. And that keeps working its way through the economy. So you just kind of have this sticky element of inflation that the world's now dealing with. And that's the bigger risk to the Fed. The Fed is actually saying, look, we don't mind if the economy goes into a recession. I mean, it's pretty ridiculous, but the Fed's kind of hoping that maybe people start to lose their jobs, the economy slows down, so that inflation does kind of get hammered in the short term and they have that under control. They would rather that than have the economy kind of stay where it's at, but have inflation too high and they can't kind of get their arms around it. So that's the big risk that they've run into. And I think they're going to be battling that, unfortunately, for the next year or two. It's going to be an ongoing process where it's not just a quick fix. They do this and then all is back to how it was before. I think, and unfortunately, we're going to be dealing with the ramifications of some really bad policy from them for a while.
Well, you mentioned one. This is what I'm looking at in this next year is the biggest number to watch right now is the labor market. Microsoft just laid off 10,000 people, and there's no reason for the Fed not to keep jacking rates as long as unemployment's under control. So they have a dual mandate. Some people call it a threefold mission, but really a dual mandate of price stability is a priority and full employment is a priority. And those are almost or can be opposing goals. And then the third thing they say is we'd like to have stable rates, but that's tough because rate is the tool that they actually use to tweak the other two and QE. And so, I think you see them aggressively and raising rates until the job numbers start to give them some pain, and then they have to figure it out. And boy, if you have stagflation, then you're really gonna then that's the real test of where they go is, you have inflation, deflation, great, pump the rate up. But if you have stagflation and you have a slowing economy and you have layoffs and yet you have prices that are still increasing, that's a rough scenario. I think you also have to help people realize that, many people haven't lived through an inflation cycle like we've had. I'm what, in my 50s. And so I remember as a child, in grade school, I saw the Carter years in grade school and a little bit of the Reagan years in junior high. So I was a young boy when we had this inflation before. And a lot of the, so that means there's probably half our population that hasn't been through this. And I think a lot of people don't realize, like, well, inflation will get back under control. It doesn't mean prices are coming back down. It means that they're going to stop increasing at the rate they are. You'll see gas move. You mentioned rents, or a little bit, but the grocery stores, I think it's here to stay, guys. And the restaurant, it's here to stay.
Oh, for sure. Well, I mean, the interesting thing about when you say, a lot of people have not lived through an inflationary cycle. Inflation's like the norm. It's kind of like the two fish swimming along, and one says the water sure is nice today, and the other fish says, what's water? You're just not aware of the environment you're in. So, I mean, you're constantly feeling inflation at a slow rate, but when we get that acute rate of inflation, I think it makes people hyper aware of it, and they start kind of looking to understand why. I think you're right, Andy. I think it is here to stay. And, hopefully
it's
that
gonna kill a lot of people because first of all, you got a lot of segments of the public that this is going to hurt. First, I think of retirees. It breaks my heart. It does, man. I mean, my grandparents were fortunate to retire. My grandpa worked till he couldn't move because he just liked to. But I see a lot of grandparents that are working and they're doing it because they have to. That's not a way to spend the golden years. There's, some people say, I like to, I'm a shopping cart distribution engineer at Walmart because I like meeting people. Baloney. You meet people at the country club. You meet people when you're out with your grandkids, but you don't work that late. That's a tough deal. And then the other part is like the single family mom. These prices are killing them. And so, this printing of the money and this expansion of money supply. And I had an interesting, podcast that we recorded about, I had a guest that didn't think the money supply mattered, and we didn't come to agreement on that, but he did make a good point. Being on the supply side of things or the production side of things is really important. To have, to have ways to serve people either through stock ownership or real estate ownership or business ownership. Being able to serve people is a huge deal right now. So what are the opportunities for this year?
Oh, I think there's going to be a lot of opportunities. I mean, a lot of opportunities. That's the one thing I will predict, I think, with confidence. There's going to be opportunities, but I don't know exactly when and where they're going to be. I think there's always an opportunity to find that hot sector that's performing well, and to identify a trend, or to find the things that are depressed in price and search for fundamental value.
That's what I think it will be.
Yeah, I think that's, and I might I don't know, I might have a slightly bearish edge on the market over the long term. Short term, I think we're going to melt up a bit. But if I were to, kind of one of those things, gun to my head, what's my directional prediction? I think we're going to see more volatility in the downside still, just because they're not quite done with that rate hike, hiking cycle that Corey was talking about a moment ago. If
you look at any chart in history, this is a pretty good lesson. Okay. If you look at any chart in history of any time frame, pick your period, pick whether it's a weekly chart or daily chart, and pick 5 years, 1 year, or 100. Instantly, anyone, a grade school level experience, say, where do you wish you would have bought? If you could do it over again, where do you wish you would have bought? And it's just easy to pick the lowest point on the chart. It's just, it's way elementary. And so picking the lowest point on the chart is awesome. The problem is it's approaching that people are losing their minds, and they're always panicking and selling. And to be able to say, look, I don't need the lowest point on the chart. That's a huge maturity. That's a quantum leap in maturity as the investor. When I say, look, I don't need to pick the bottom, but what I can see is, from a fundamental standpoint, I can see value. I can say, you know what, this price now is low enough that when I look at the dividends that's there and the potential for call writing is there and the strength of the company in these tough times, I think there'll be resilience. And I think that when the economy goes to the next cycle, I believe in American business. I think I'm getting a really good deal here that can achieve my goals. And you might not get the bottom, but when you can do that and you can buy with confidence when it's on sale, it's a huge thing. And there's 3 or 4 reasons people don't do this. Number one, they're inexperienced and emotional. They're losing their mind like everybody else. Number two, they don't have the dry powder. They don't have the assets set aside to really pounce like Buffett can. And probably the most important of the 3, though, is because there's ways you can enter with small amounts of money, is they don't have the education to do it. And it's a shame that when the opportunity comes, people aren't prepared for it. Go ahead.
That right there is a huge, huge point. When the market's on sale, so the market has come down about 20%, and it certainly is susceptible to going down another 15 to 20% from here. So I mean, when you think about that environment, think about what it's going to feel like at that point in time. When the stock market, since I've been investing, there have been basically 3 bubbles, major bubbles. There was in the late 90s, there was the tech bubble, right? In the mid 2000s, there was the real estate bubble, the global financial crisis. And then I would say that we had kind of the COVID bubble, where massive amounts of money was printed, checks went out to everyone, a huge increase in money supply, and it was crypto and it was NFT and it was buying growth stocks and this and that, and just kind of inflated prices. And in each of those cases, what drove the bubble was envy. It was an emotion of envy, because in the late 90s, when everyone was making money off of the dot-coms, you didn't want to be left behind. You wanted to be making money like your neighbor and buying a new boat. And so people just rushed in. It went viral. And of course, that collapsed and the NASDAQ lost 85% of its value. Fast forward 10 years later, global financial crisis in 2007. Interest only, no doc loans, people buying real estate. Everybody said real estate prices will never go down, and we crash, and 10 years later or so, a little bit more than that, 2020 hits, COVID, we drop, massive amount of increase of money supply. And again, the trend went elevated, and crypto and NFTs and all these things boomed. And what each of those had in common was the envy factor, where people didn't like other people making money without them. Well, in each of those circumstances, you had a pretty significant market meltdown. But the market, when it melts down like that, that is your opportunity. That is the single best opportunity you have as an investor, like you were emphasizing. Now, when that comes at a discount, though, it's an entirely different emotion. It's weird, but people love to buy on envy and on greed and on chasing. And then when it's actually a good opportunity, they have no stomach for it. And again, it comes back to education, but it's the emotional thing. When you flip on the television, they tell you how bad the stock market is and how badly it's going and how much the stocks are down and how bad this is for the economy and so on. And you just get in this cycle of negativity. And of course, people hunker down. Not only, and even worse than that, unfortunately, the general public sells and they give into their fears and they dump their stocks at the worst possible time. And it's just this cycle that constantly goes through over and over and over again. And those that learn and educate themselves are able to take advantage of those cycles. And those that don't have the education will continue to fall victim and be susceptible to the envy and to the panic, and those create huge problems with your investment portfolio. So it's just such a huge point that you made there about the opportunity. We should all be rooting for a down market because that presents the best opportunity to buy, but people just don't do that.
Well, as a cash flow investor, I just don't care when my net worth fluctuates. I care when the cash flow changes. You feel pain when cash flow changes. You don't feel pain when your net worth changes so much. And 401k people are all about net worth. Isn't it interesting, though, how much temperament plays into this? I mean, on the podcast, people are often, I think some people are puzzled at the beginning of a show where I'll say, here we have, neuroscientist Tally Sherritt, with us today, or someone like that, because it's about emotions and how we react to things big time. So, as far as the State of the Union now, I here's my thoughts on 2023. I don't know it'll be as good as COVID, because COVID fell so fast. It was like a flash sale. I mean, it was just undeniable. I mean, you knew that the world probably wouldn't come to an end. And if it did, then who cares, You'll invest now if you think it's going to end. But you just had a feeling that, we're going to get a handle on this, and it's going to have a beginning. It's going to be nasty. It's going to be awful. It's going to be a couple of years. But, the sun will come out again. And I had no idea that we were going to double the market after. No idea that we'd not only recover, but double the market. But I didn't know the prices were low. So we picked up some nice stuff. And our students picked up some nice stuff. What was interesting was how behind people were educationally. I was blown away. We had a webinar system in those days that would hold about 10,000 people. And that thing blew out like immediately. I mean, people could not get into the webinars because everyone was panicking, like what to do. So that's human nature. To have a New Year's resolution of, look, I'm going to be prepared if this gets away from us. Great. I think that this one will be more of I don't know that we'll see drastic downward turns unless there's a catalyst to that. But, I can see us, some companies creeping down. So we'll see. If they don't, doesn't matter, because it's about being prepared more than a crystal ball. It's about preparation. If you can trade out, I tend to make this shift every year. I remember last year, I think it was Robert Kiyosaki. He asked me to, can't remember what it was. We were on some type of live stream and they were asking us for predictions or something like that. And I tend to pivot from prediction to preparation often, because preparation is smarter. You can say, well, I think the market's going up, or I think the market's going down, or I think the market's going sideways, and place your bet. Or you can say, well, here's 3 scenarios. Maybe I'll create a plan of what I'll do for all 3. If it goes up, this is what I'll do. If this goes down, this is how I'll react. If I'm wrong, here's my plan B. So any thoughts on preparation as opposed to prediction? I mean, isn't that what, Noah, that's all about, the trade adjustments?
Oh yeah. Well, I mean, and a lot of that was my entire trade adjustment playbook really came down to being, one, pretty mediocre at predicting the future. 2, having a bad temperament to start out with as an investor. And 3, learning that when you are prepared, the opportunities will present themselves with more clarity. It's easier to see them when you're prepared. And even if we, get it wrong from time to time, which we do, having a plan in place to control the downside risk. I mean, it could be just as simple as having, a stop loss. Some people don't like that methodology, but it's effective. It could be something a little bit more complex, like knowing how to use options to hedge off that risk. And so, or to generate extra cash flow. So, again, whether it's up, it's down, or it's sideways, again, I don't think it's the ability to predict as much as it is the ability to react to the situation presented to you and make decisions.
Let's talk about asset classes for a little bit. So we've been mainly talking about stock. I think it's an incredible time to look at businesses. I think it's an incredible time. It's always a great time to start a business, but I think now is as much as ever. What are your thoughts on real estate? To me, again, I don't think it matters. Everyone is worried about, rates going up. So mortgages are going up. That's going to soften some things. I don't think we have as many people upside down as we had in the 2008 crash, but I think there's going to be opportunity in real estate because all those rates just pass through. I mean, it's not like you're going to get killed. oh, we can't do this now. No, there's still going to be distress. There's still going to be opportunities to improve. I don't think the real estate market, opportunity wise, changes at all. Even though the overall indexes will fluctuate, we'll certainly see housing slow. But as from an investing standpoint, I don't see a problem.
I'm hoping for a discount window personally. I'd like to see some prices come down. But again, I agree with you, and I don't know that it really matters. I think there will be opportunities, and again, it kind of comes back down to education. Understanding, how to do the numbers, how to crunch the math, find the right types of assets. I'm again hoping for some fine opportunities and just being prepared to take action on them.
Yeah, and to your point about cash flow, it kind of the difference between worried about your net worth and worried about your cash flow. Most people, let's say I buy a rental property, as long as I can get my renters in there and they're renting, I assume that property is going to go up in value over the longer term. Now, it might have some bumps in the short term. That's worrying about the price of the asset. Well, if I'm not selling that home anyway, what do I care if its price fluctuates for the next couple of years, right? I'm worried about the cash flow. As long as I can rent it out, well, then I've got that cash flow coming in and its price will go up and down. And I do think, like you said, there will be some softening just because the cost for people to get into homes is more expensive with mortgage rates having gone up and so on. But I don't think the market's dead by any means. And interestingly enough, I have this little philosophy on real estate where Chick-fil-A spends so dang much money to research their areas. I don't think it's a bad idea when you're looking at real estate places to go follow Chick-fil-A. Wherever they're putting in a new Chick-fil-A, hey, go look for some real estate in that area. See if there's some distressed properties or whatever. So I was doing a little of that last night, just seeing what was out there. So that's the Chick-fil-A method, I guess.
I used to do that with Starbucks before they put a Starbucks everywhere. Yeah. And then the system no longer worked.
Now the system doesn't work. I mean, Tommy Lee has a Starbucks in his front room. Did you see that on his trips? I mean, when that's when you've made it. When you're Tommy Lee and you wake up in the morning, you got a Starbucks in your front room. That's pretty good. Doesn't have the barista in there. So gold. What's your thoughts on gold?
Well, the precious metals have been pretty hot recently. I mean, we've seen quite a bit of upward action in them. From a technical perspective, I think there's more upside room. They're a little overheated at the moment. But again, it's the type of thing where you can speculate on gold, or you could have a different frame of reference or mindset on it where you could think of it as a value store. I mean, that's kind of what I think of it as, is just a different asset class value store.
I don't think I'm going to buy more gold. I look at gold as an emergency store. I look at it as a hedge. Gold doesn't produce anything. It doesn't cash flow. And I'd rather invest in more cash flowing assets. I think once I don't know, can you ever say you have too much gold? I guess you can have too much of anything. But I think I still write puts on paper gold. Because if it dips, I want to get paid to buy it. So I still write out of the money puts monthly on paper gold, because I think it's something that tends to go up over time. And I don't mind buying a dip, and I usually just like them to expire worthless. But I don't like gold as a mainstay. It's part of what you do. I think you want to have some gold and silver, but I don't think you buy it to get rich. I think you buy it for emergency. I think you buy it to hedge. Thoughts, Corey, on that?
Historically, it does a good job of that, where in times of market turmoil, it holds up better than the equity markets. It holds up better than a lot of other things. And that's kind of what it is. It's meant to be defensive. I mean, at the end of the day, it's just a shiny metal, right? I mean, that's what it is it's a shiny metal that has a purpose. But yeah, I'm kind of with you. If you said, would I rather have a ownership in a big productive business or own this shiny metal? Well, I'd rather own the big productive business. I've seen that business can do a lot better than the shiny metal can, but it deserves a place in my portfolio in terms of I can cash flow off of it with options. I can do a variety of different things, but I'm with you on that. And if you kind of look at it from the standpoint of its relative strength to the S&P, it is kind of interesting that over the last year or so, the S&P is making new lows versus gold. So gold is holding up way better than Bitcoin and crypto and other things as kind of an inflation hedge or anything like that that aren't really doing it. Gold and silver and some of those commodities are holding up better. And like I said, the S&P is hitting new lows on a relative basis versus the S&P. So gold is up and the S&P is down by comparison. So it's got some good factors that way, where if you had held your gold over the past calendar year from 2022, for example, you're up in gold and the S&P is down 20%. That's kind of what it's designed to do.
So you really stepped in it there, didn't you? You had to use the word crypto. So now we're going to talk about it. You know, did I send you guys that article that I'm blown away that there's not more ink on stable coins, particularly Tether. And I don't mind making bold predictions here and being wrong on this. And people come back and they'll say, Andy, we told you so, you were wrong. And I'll say, yep, I was wrong, because that's happened to me a million times. So I'm not impervious to being wrong. But I'll tell you, something's wrong with Tether. And I'll tell you why. Here's what's really weird. This is what I don't get. What is the attraction to, let's say, for example, a Bitcoin? Well, let's look at the things people like about it. It's got this immutable ledger. And so that's true. The amount of computing power it would take to hack that ledger would be, significant. I guess anything's possible, but it's minutely, it's not probable. It's huge. You have to it's so big and spread around. And that, number two, it's open. It's transparent. It can be not just double checked, but, almost infinitely checked. It seems like that's the power of the blockchain. It's non-centralized. And so these are the things everyone loves about it. Hey, it's not controlled by a government. It's non-centralized. It's an open ledger. It's transparent. You can track everything. Had to mute myself. I got a little bit of a cold. So if you hear me mute a little bit, it's to save everyone's ears. And on the other side of that, we have this money market system. And for those that haven't gotten into crypto, but have stocks, generally in a stock account, you move from equities. And if you sell an equity, that cash that comes from the sale of the equity goes to a money market. And so in that sense, that's what a stable coin is in the crypto space. It's hard to go from crypto to cash and cash to crypto because banks don't like it. So you go from Tether to Bitcoin and Bitcoin to Tether, and about half those transactions go through stable coins like Tether. Tether's still the biggest one. So here's what's weird about it. So in the trading world, you're going from this decentralized asset to a centralized asset. You're going from an open ledger that's audited constantly by everyone to a ledger that's closed and audited by no one, and more so by people who have promised to audit it but have never followed through ever, and they keep procrastinating that. You have one central place that controls billions of dollars. And I'll tell you, if Tether goes down, it'll be a freaking bloodbath. What's interesting is Tether has, a sister company, and they took some of these funds to bail out their own sister company, and they got called on it. And so the government fined them a few $1 million, and they paid a settlement, said, yeah, we'll pay this settlement. We shouldn't have done that. And so it kind of tells you the people you're dealing with, though, doesn't it? Doesn't that tell you the type of people? Because here's the thing people should understand about Tether. A money market it's called breaking the buck. A money market needs to keep that. If you put $1 in a money market, you got to have $1 there tomorrow because it's supposed to be safe. So generally money markets invest in government securities, basically treasuries, and they might do some commercial paper. And commercial paper is fairly safe because it's short term. If you loan Apple money for a month, that's pretty safe. You're going to get your money back, if you have a short term deal. Well, these guys had huge parts of what they claimed to be in commercial paper, but you couldn't find anyone that was doing business with them. Like if you're making up 1/6 of the world's commercial paper, you ought to go to some of these people that lend it, say, hey, you doing this with Tether? You borrowing from Tether? Like, no, we're not borrowing from Tether. Well, who is? And the fact that if you make a promise that you're going to be audited and then you switch auditing companies or you make it just has the telltale signs of scrambling. One or two things, I think. They're either scrambling to get their stuff together so they can be transparent, or they're just not, and they're kicking the can down the road.
So many red flags.
I mean, oh my gosh, if you couldn't see Enron coming, okay, fine. If you couldn't see Bernie Madoff coming, okay, fine. But this thing has red flags everywhere. And the dogmatists hate me for this, because if you're a crypto fan, it's almost like political or religious that I'm stepping on a sacred cow. Look, they lied. Yeah, but you can blah blah blah. Whoa, 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 whoa! You want to do business with people that lie? Come on. That is the pattern has been lying. It has been not disclosing, and it's been breaking of promises of transparency. And those are just, we don't know what's behind those facts, but we do know those are facts. We do know that they've been dishonest. We do know that they've promised to do things and they haven't done them. Moving dates around, blah, blah, blah. The dogmatists hate this kind of talk, but you can't fall in love with your asset because your asset is simply just that. It's just an asset. It's not your wife or children. You don't have any. I don't need to love my assets. Okay, I've gone on my soapbox. I'll shut up and let you guys.
Well, I don't know, Andy, especially in light of the recent FTX shenanigans that have really. What I'm surprised most about is there hasn't been more press or bad press on that. I mean, that was magnitudes larger than Bernie Madoff.
Yeah.
And
people,
I just recently rewatched one of those Netflix Bernie Madoff shows. I just the whole time into my head, I'm thinking, this is Tether. This is exactly what's going on. Have you made any transactions with this, this Madoff outfit? No. I mean, they went around. It took them a long time to figure it out, but there was some incompetence in the regulators, and you're talking about an industry that has precious little regulation to begin with. And I don't know. I think there's going to be some more crypto shakeout. I don't know if that's a bold prediction or not, or if that's just looking at red flags and asking some questions.
Yeah, and I like the Warren Buffett where he told his directors, lose money for the firm and I'll be understanding. But if you lose one shred of reputation for the firm, I will be ruthless, and it's got to kind of come back to that of, they're telling you, look, they're not reputable people. I mean, if you're lying about something, then you've lost all credibility with me. Like, why are you lying to me? And as soon as they start to show that, and that's not to say that everyone in the crypto space is that way, but there are a lot of bad actors in that space. And that's what kind of happens with a fast moving market like that, is it just brings out a lot of,
well, you better believe
of bad actors, and there's plenty of them out there. So the Sam Bankman-Fried and the CFO, the COO, a few of them have already, said that they're guilty, and I guess he's holding out that he's innocent and such. But there's just a lot of that in that space, which, again, some of the creation of those things, they were just doomed from the start. I mean, I don't understand a lot of the, and this comes back to education. I feel like they're taking advantage of people's credulity, the fact that these people don't understand it, but they can see the money signs, and so they get sucked in by greed and by envy, and so people are putting their hard-earned money into things that they're just not real good solid assets, and they're doomed to have collapse. And you're seeing that in a lot of these Tether-like products. Even if Tether hasn't fully collapsed, a lot of the other products that are similar in nature have collapsed, and people have lost their investments. And I think there's going to be more of that in that market, unfortunately.
No, to Tether's credit, they have survived some pretty big liquidity moments. Like,
for sure.
To their credit, they've had some runs on the bank that are pretty big, and they've been able to cover those for the most part. So,
and I'm not sure how they have been able to, but they have to this point.
They have to this point. We did an experiment in 2022 on crypto. And it's interesting because we bought some crypto in our Mentor Club. We just bought one Bitcoin. And in our, we always use a paper trade account to teach from, but they didn't have any paper trade accounts for the most volatile asset and the most dangerous one, right? No, none of that.
No practice. Yeah, no practice needed for that one, I guess. Yeah,
you're just going to rock and roll. But it was an interesting experiment because we're down. Oh, let me just bring it up here. I've been bringing it up while you were talking. We are down about 20 grand is all. So that's interesting. Where we should be down, much, much more than that. What's interesting is the worst thing we did is we took all the premiums. I'm kind of adding it up here. I downloaded while we were talking. I downloaded a sheet. I don't know if I'll be able to get the right total on it, but it was kind of funny because we said we're going to take all our profits from the premiums we sell and that we collect, and we're going to reinvest it in ETH. And so we put it in Ether. And so that was kind of funny. Had we not done that, I think we'd probably be down maybe 10 grand or so, something like that. But what's interesting, where I was wrong in that experiment, was I really thought that and I think FTX really had a lot to do with this, is I thought the options market would become better over the year. I thought it would become better faster because, in the 70s, when the options market for stocks was still developing, you had the same illiquidity, you had the low participation. And the downside of the options market on crypto has just been awful spreads, awful wide strikes, awful liquidity. And since FTX, man, it's gotten worse, not better.
Yeah.
Premiums aren't for considering the risk that's there. The premiums don't really match up with the risk you're taking. The spreads are awful. Getting filled is a question mark. It's gotten a lot worse, not better. And you would think that an asset that's getting stronger like this, or if it's getting stronger, you think the options market would be more robust. Thoughts on that?
Well, it took 20 years for the equities options market to become liquid and functional and popular among people. And I think it's one of those things where there's so many instruments out there, like so many instruments and options on crypto. I mean, brilliant idea. It certainly needs insurance, right? Certainly there's a service to be provided there. But again, if there's no liquidity and the transactions aren't there, I think it's going to take a little bit more time for those to come to where they're more functional than they are now. And I have no idea how long that is, but.
And just to demonstrate how good they've been, just in terms of your positions that you've been demonstrating with the crypto, if Bitcoin went from like 65,000 to 20,000, that's a $45,000 loss. And if you're down 20, you've more than cut that in half in terms of your risk. And you've taken the premiums that you collected and bought Ethereum. So if Bitcoin, but if Ethereum and Bitcoin rebound dramatically and say they go back towards, Bitcoin goes back to 65,000 and so on, you'd be net way ahead in terms of, and we don't know what the future is going to hold, but that's where there's huge advantages in a downward moving market or in a stagnant market to using the options space to just generate some cash flow. And it's kind of that real estate analogy of, well, if I'm a long-term believer in whatever this asset is, if I can generate income off of it and not get rid of the asset over time, still I'll be able to participate in its price movement, but I'll be cash flowing off of it, because most people just buy their Bitcoin and it sits in their wallet or whatnot, and they have no more upside than its price fluctuations. They do the same thing with their gold, right? We buy some gold, it sits there for years on end. Well, what we teach and the way that we educate is to conservatively and carefully generate some income off of it, so that it's just not an asset sitting there. You can actually cash flow it. And then you can take that cash flow that you're bringing in and buy other assets, or buy more of that same asset with that cash flow. That's what you did with Bitcoin. As you'd collect the premium, you'd buy some Ethereum, collect the premium, buy some Ethereum. So it's actually buying some more of another asset. And we can do that with stocks. We can do that with a variety. You can do it with real estate. You could take the rent you're bringing in and start to pile that up until you have enough to buy a new property and put your 20% down or whatever. And now you buy another one. And as the rent comes in, you can kind of use that to buy another asset with it. And that's a beautiful concept, especially in a down market or a sideways moving market.
For sure. So, I think the problem with Bitcoin is people see it as a way to get rich. The same way they would see, buying gold as a way to get rich, where, it's a currency. It's really not a currency, because it's not flowing to buy goods and services as much as it's become a commodity, of investment. I do say this, though, to the dogmatists that are saying, hey, why are you saying all these things about crypto that are not exactly positive? Well, I think money's going to change. And I think that just as it feels like the 1990s to me when it comes to that stuff, I think money's going to change, because the status of the US dollar as the world's reserve currency, I don't think the world wants to keep it that way. I don't know that it's their advantage or disadvantage to mess with it. But there's just no question that money in itself and what we see as money has always been changing. Throughout history, it's gone from being, feathers or seashells or gold or, whatever it is you want to make money, or, this unit. What's been tough about money is, I had an interesting conversation with one of my podcast guests, and he wrote a book that had money should be a unit of measure. Wouldn't it be nice, like a yard is a yard, a meter is a meter, a kilo is a kilo, wherever you go, and it measures weight, length, to measure value in a constant way. That's always been the difficult thing, because if money is a unit of measure, that yardstick in and of itself, starts to change. It's really hard to, we have teaspoons and we have gallons and we have liters and we have all these standards that are fixed. And when you look at money, we've never been able to measure value of stuff very well with some type of yardstick called a dollar. It's been tough because the yardstick in and of itself has been fluctuating.
Yeah. And I think there's so much utility in having it fluctuate for those who generate and create the money to begin with. Like there's a certain amount of power that comes with that. But yeah, I don't know if the dollar's going anywhere. I think it may change format. Like I think we're going to see it digitized and just become purely digital.
It would be interesting because in our day and age, you have privacy laws, or at least what people would hope would be rights to privacy. Do people care that every transaction they make is tracked? Well, if you're not doing anything nefarious, maybe you don't. I'll tell you what I would see as a positive to that drives me crazy is, when someone says, hey, pay me in cash, that always bothers me, because I almost want to say, well, I don't almost want to say, I want to say, why? Because if I'm going to do am I going to do business right now with someone who is dishonest? So I don't pay people in cash. If they don't take at least Venmo or, something, I don't like to pay in cash very much because, the amount of fraud that goes on is unbelievable. So anyway, that would be one advantage to digitizing it. But there's a lot of Orwellian fear to doing that. In China, if you're going to have a social score and they see how you spend your money and what you spend it on, if the powers that be have a poor opinion of that, poor Corey, all his bill on, booze and cigarettes and gambling. And,
you know me.
Jackie's
Yeah.
Bigelow bill is going to go up,
Right.
So the bartender can cut you off. Is that the analogy here?
Is that it? I don't know, but
let's hope not.
But how many shoes are you going to buy, right?
Well, now you're getting to accuracy there. If you're talking about my wife buying shoes, now.
No, here's the thing about Noah's wife. She's going to buy a new transmission for a 68 Corvette. That's what she's going to buy. Yeah. No problems there. Right.
Well, she's going to have a high social credit score, so we're okay.
Yeah,
on the other hand, I will.
All of our wives will have better social credit. All of our wives have better social credit scores than the three of us. Okay.
Yeah. See, Andy and I, we argue with our wives about who's the better driver. Noah can't even argue with his wife.
Noah doesn't even have
just accepted. Accepted that Melanie's so much better than he is.
He just sits in the passenger side, and you can see his fingerprints in the dash trying to hang on for.
Hey, she's taller and better looking too. All it proves is the one thing I am better at is I'm a better salesman. That's all there is to it.
That's true.
I don't know. Melanie knows what the exit strategy is. She knows, and so that's a little bit of comfort. She knows that all three of us outkicked our coverage. That's for sure.
Yeah, don't teach my wife about a stop loss, please.
That would have happened. She knows what that is. No, you guys land. You guys are good lands. I mean, you guys do well. Really a fun conversation, guys. I love this stuff. I mean, we're the luckiest guys in the world that we get to do this every single week, and we're grateful for everyone that supports the Cashflow Academy and its mission. We've grown and grown, and it's been an interesting thing. There are not very many financial education companies that can say they've been around. When we founded was 2007, and there's just not a lot of people that have the staying power. But I think it speaks to you guys as instructors and the fact that we attract serious students. So it's great to have the faculty here and to share some of the thoughts that we have on the new year. Your closing argument or statement, Noah?
Well, again, the boldest prediction I'll make is that there will be opportunities, and it comes down to having the education and the preparation to be ready to take advantage of them. I don't know where they are going to be precisely. That's something that kind of those opportunities present themselves in real time. But when you put in the work and you do the education and you get the preparation down and you work hard at it and you're willing to take those risks, calculated risk with the education, that's when the opportunities will have, the good chance to pay off for you. So.
Well said. Corey, final word.
Yeah, I think, and I was susceptible to this when I very first started a few decades ago, that when you pay too much attention and too much worry about the day-to-day fluctuations, you're not doing yourself any favors, and so people get really happy when the market's up and they get really sad and depressed when their stocks are down. And it's the wrong mentality. And if you'll just make a switch in your life and you'll say, I want to set a goal to acquire more assets. If I own more assets, my cash flow is likely to increase. My net worth is likely to increase. My profitability long term, all of the goals that I want. And oh, by the way, if I happen to get into anything where I have to pay a medical bill, I have some assets there that I can sell, and stocks are liquid. I could go in and sell and I'd have the capital that I need for my family. But if you change your mentality and you say, my new goal is not to worry and be emotional about the markets. Instead, my goal is asset acquisition. And you make that mindset switch, and you start to try to acquire assets, and you own 5 shares of this and 10 shares of that, and pretty soon it grows over time, and now you own 100 shares and 200 and 1,000 shares, and that's what compounding is. And as you'll build up that asset column, it's going to make a meaningful difference in people's lives. That's the mindset shift that I think people need to make. Instead of worrying so much about predicting the future and all those things that are only going to cause you, emotional swings, focus on, did I increase my asset ownership? And if the answer to that is yes, I'm happy. Whether stocks are up or down, I'm happy because now I own more shares in the market. I own more stocks. I own more real estate, whatever that is. And that's a better mindset to have. And then you'll find opportunities, because as the market comes down, your focus is on acquiring assets. And now you get to buy more shares at lower prices, and your ownership stake goes up dramatically. And so I think that's just a huge shift that everyone can make, and it'll make a meaningful difference in people's lives.
Oh, that's well said, buddy. That is well said. I would talk a little bit about risk. There's so many different types of risk, and it's really important to take it, and to manage it. And to me, the big question, if you want to take, Corey's long view and long-term view, is what is human nature? Well, I think human nature is to want a better life. I think I think capitalism, in and of itself, is about producing more stuff at lower prices to more people and better quality items. And as long as people have a desire for an iPhone that's better than the last one, or an interconnection that's faster than the last one, or a car that's more fuel efficient or green than the last one, as long as we want food that is better than the last food we ate, there's going to be opportunity for entrepreneurs. And that's what stock ownership is. The socialists of the world, and I have some really interesting, I have some relationships with some guys that are socialists, and I can't say the majority of my friends are that way, but I do have some. And I can coexist with them because they have good hearts and they know I have a good heart. But I will tell you this, the beautiful thing about the stock market is the word share, is that if people could only share and understand they can share in global wealth, they can share. There's a misconception, in my opinion, that there's the Jeff Bezoses of the world that just get rich, and the Steve Jobs of the world, and there's this elitism and that. But my sons are on track to become financially free because of the compounding that they're doing. And the crime is people don't start early enough. If a young man starts early enough, they can have a very, average, maybe even modest return. But with the consistency, if they believe in American business over their lifetime, they can become very, very prosperous by sharing in the global wealth. Warren Buffett is not in the same category as Jobs or Bezos because he never started anything. He never started a company. He bought companies, including Berkshire. He bought Berkshire because he was pissed off at their owners and wanted to take over their company.
He bought failed businesses like Berkshire.
And what's interesting is he's just shared in the wealth. He's not part of Wall Street. He lives in Nebraska, and he doesn't participate in the Wall Street stuff. He just has stocks, and there's a big difference there. So I just tell people, if you believe in that people are going to want better goods and services, and you don't know how to build an iPad in your garage, let alone 350 million of them spread around the world, go buy yourself some shares of Apple, and you can share in that prosperity. You can share in that growth. You can share in it. Now, do you have to buy your shares? They come for free? No, but I don't even think the most, the most crazy socialist might say everything needs to be for free. But even a person who criticizes capitalism might come to the sense that, hey, you're going to get it out of life what you put into it. And, certainly you deserve maybe things like life, liberty, and the pursuit of happiness, but you can invest and you can contribute and you can serve and you can serve through labor, and you can serve through ownership. So I think it's a beautiful, beautiful time. It's an exciting time with lots of opportunity in 2023. I agree with you guys. There's going to be stocks that we can buy if we're watchful and if we're mindful in this year that can, change our lives even better. And we've got pretty good lives, guys. We got a lot to be grateful for. Hey, can I share a personal note with you guys?
Yes, please.
It's a special day, and I won't get all blubbery on it. And I haven't made this really that public, but a year ago, Marcy was diagnosed with breast cancer, and today is her birthday. So we have a year down, and she's with us. So it's kind of a special, we've all had health problems. Corey and I are both cancer survivors as well. And Noah has, he has his own category of stuff.
I got a good story.
Yeah. But every year, the three of us, your time, it's like Steve Jobs said, your time is limited. Don't waste it. Don't waste it by living someone else's life, and don't be trapped by dogma. Find in your heart, because it knows what you want to be, and have the courage to pursue that. And so it's kind of fun.
That's awesome
to have a year down, and
happy birthday to Marcy.
Big happy birthday to Marcy. We're old now. Our kids are young. I had testicular cancer, so our kids came late in life. So all my friends are like grandpas now, and I've got an 8th grader.
That's awesome.
Hey, I got a kid in kindergarten. How about that? I'm in good shape.
So we're gonna go celebrate. Marcy's birthday, because it's a special one for sure. She's had financially, it doesn't matter what you have or what you acquire. Those things are real for every single person. And boy, she's been a champion, man. Those treatments are no joke, and she has had one heck of a 2022, man. It's tough. So we're hoping 2023 just gets better and better. We're pretty optimistic around here. So
that's awesome.
All right. Awesome stuff. You guys love and appreciate you. You've been listening to the lead faculty ramble on the Cash Flow Academy show. We hope you enjoyed the conversation. Most of all, we hope you got something out of it, and that some determinations might have at some point grown in your heart. That's the biggest purpose. If you listen to this conversation, at the end of it, you had some determinations of something you want to do to improve your life, then maybe this was a small success. So thanks, Noah. Thanks, Corey. And we'll see you guys next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.